We've now had a paper coming out of the Treasury Department about deregulation. You've studied it, you know it. What do you think of it?
Well, there's quite a bit in that paper which is somewhere between affirmatively good ideas, things like helping smaller banks, raising the threshold for systemically important institutions, to things that are debatable. Maybe you want to do them, maybe you don't. There are some things in there that I wouldn't do, but wouldn't be the end of the world. But there are two categories which I think should be troublesome to everybody. One is the effort essentially to emasculate the CFPB, the Consumer Financial Protection Bureau. And second is a series of proposed steps which would reduce the capital levels of our very largest banks. I won't say much about the first other than to say I hope that people don't have amnesia about what happened to consumers in the 2001 to 2008 period. With respect to the second, we can do a lot, I think, to play with, to dial down some of the regs as they affect smaller banks and even large regional banks like BB&T or U.S. Bank, which have big balance sheets and do an enormous amount of lending. When we talk, though, about those 8 largest systemically important institutions, troubles at any one of which could pose a risk to the financial system, I think it's there where we want an extra margin of safety, and there where we need to keep the capital levels up. I would say actually somewhat higher, a little higher than where they are now, but certainly no lower.